last trading day of the first quarter of this year, and North American equity markets are stumbling. It's certainly clear to say. Potentially the biggest market mover of the week will be on this Wednesday, on, quote, Liberation Day, Trump's term for when several of his global tariffs will take effect. Well, some investors worry about market declines on tariffs and other macro issues. Our next guest says the data are likely pointing to a slowdown, not a recession. We'll dig into that. So should you use this drawdown as a buying opportunity? Joining us here to unpack the macro themes on his radar for the trading week ahead and what they may mean for you and your investments is Director of Global Macro, Jurrien Timmer. And just before, actually, Jurrien, we jump to you, I just want to say that we can remind viewers that today's webcast has the option for you to listen into a live French audio interpretation. So you can simply change your audio settings in Zoom and listen in French. En français, so please do. Welcome, Jurrien. Great to see you. How are you?
Bonjour.
Bonjour. Fantastic. And we'll invite everyone to send questions in both official languages. We'd love it. Let's talk a little bit about the markets that we're looking at right now. You've been filling us in on sort of anatomies of corrections. We're still here and still selling off. Where do we look to?
Yeah. So, yeah. Q1 2025. How time flies when life is chaotic, right? So maybe we go to slide 1 and just try to just unpack, I guess, the last 5 months, if you will. You know, there's an old saying on Wall Street that when things are obvious, they are obviously wrong. And that's not always the case, of course. But, you know, we had this election in November, as we all remember. And the playbook seemed extremely obvious. You know, this was going to be a pro-growth, laissez-faire type, another French word, another kind of administration that would let sort of the business of America be business. And that refers back to the motto back in the 1920s when, Calvin Coolidge, Herbert Hoover were in charge. And that was the playbook. And so that would mean, obviously, rising yields, a higher dollar, a strong stock market, maybe more U.S. exceptionalism. And then the tariff part, I think everyone in the market was just kind of keeping their fingers crossed, hoping that that would be a means to an end, you know, the art of the deal, and nothing more. And so that whole playbook got priced in. And then, of course, as often happens, you know, buy the rumor, sell the news, or sell the rumor, buy the news, which Liberation Day may very well end up being. And obviously a toxic term because it's not going to be liberation for everyone involved. But so the market then peaked in November, the Mag 7 peaked in December. And now, of course, this whole trade thing seems to be becoming more the end than the means to an end, and the market is struggling with that. And of course, on April 2nd, we will presumably know more. And even if it is just bluster and the art of the deal, imagine if you're a company, making stuff in the States or in Canada, for that matter, and you have this chaos around you where you don't really know the rules of the road and what your costs are going to be. You know, even that alone is going to be detrimental to growth, even if no recession happens. So let me just kind of unpack this. This is the S&P 500 equal weighted index. Uptrend is still there. You know, we know the math, right? The market goes up 10% over the long term, but it only rises 70% of the time, or 60%, 70%, which means that it goes down 30 to 40%. And of course, surviving and managing that 30 to 40% is what separates the compounders from the tourists, if you will. And so we want to be on the right side of that. And surviving those times is what is sort of the price of admission. So far I look at this chart, there's nothing really not to like. We have a correction in an uptrend, happens all the time. You know, the market has a 40% probability of being down 10%. And if we go to the next slide, we see all corrections of at least 10% lined up. And, you know, it's kind of a hot mess, but clearly we're in a correction. It's been pretty fast. And interestingly, we seem to be mimicking the 1998 long-term capital management cycle, which of course is totally different from today. That was a time when the economy was fine. It was a non-recession bear, so the market fell 22%. There was no recession. Greenspan eased rates, but that was a case of the entire world led by an army of PhDs doing what was called the convergence trade. So, when the euro became the euro, the trade was you buy Spanish bonds, Italian bonds, you sell German bonds, and you bet on that convergence. And same thing with corporate bonds. And so everyone was in that same trade. It got unwound. The market fell. The bond market felt it more. And of course, that's nothing like what we're seeing today. But in the same way, we have crowded trades being unwound in the form of the Mag 7 and just the US versus ex-US in general. But the question we all want an answer to, of course, is, okay, we're down 10%. Then what? What does the market math tell us that happens next? Can you just close your eyes and buy a 10% decline? And if we go to the next slide, you will see that the answer is a emphatic no. Doesn't mean you sell it either, but this chart measures all of these analogs from the point where the market was down 10%. And as you can see, it's just a hot mess of dispersion, right? So for every time that the market immediately recovers, there's a time where it continues and goes down to 20% or 25%. And so there's really not a lot of signal just looking at the anatomy of drawdowns. And so that means we have to look elsewhere for clues, right? What happens to yields? What happens to the expectations for Fed cuts? What happens to credit spreads, right? Credit spreads are important. Not to keep rambling on here, but they're important because credit spreads can be a clue to whether this is just a garden variety correction that is undoing a crowded and expensive market, and that's all it is. And the market, of course, is replete with history of those exact kind of corrections. We had one last summer when the yen carry trade was unwound. Market fell 10%. I can guarantee you almost no one is going to even remember that. That 10% was very quickly forgotten. So it could be just that. But what differentiates a recession bear versus just a plain correction, a repricing, is going to be obviously the fundamentals, and credit spreads loom very large there, and we can talk about that.
Yeah, I wonder if we can actually just go into what credit spreads usually are a canary in the coal mine for what it means for the equity risk story, one way or the other. I mean, risk in equity is getting a takedown, but we're not really seeing it in the credit market. So that I guess leads to a more sanguine approach.
So far, yes, and we talk to our different counterparts at Fidelity all the time, and we had an asset allocation meeting last week internally, where our bond folks were present. And again, right now the assessment is there's nothing to see here. That could change, of course, but if we go to slide 4, this just shows the exact same correction anatomy as I showed before, but this time for credit spreads. And again, it's a very dispersed set, but the investment grade option adjusted spread is up 20 basis points from a historic low, right? Spreads were only 110 basis points, which is extremely narrow, and they're up 20 basis points from that. So on the surface, that really doesn't tell you anything sinister. Another way of looking at it is on slide 5, which is a weekly chart showing the drawdown in the S&P in the blue, and sort of the drawdown, for the lack of a better term, in the credit spread. And you can see that they're mostly correlated, which makes sense, right? Credit is a risk asset, and equities are a risk asset, so they should move in tandem. But if we look at slide 6, which is the wins the award for psychedelic chart of the day chart, if you do a scatter plot of spread widening on the horizontal and S&P drawdowns on the vertical, and you look at that little dark dot there in the upper left, we're kind of in the nothing category right now. Like, it's just noise. So there really is nothing happening so far that tells us there's something more fundamentally sinister going on. And again, that could change, right? Spreads could widen 50 basis points tomorrow, and the chart would look different. But when I look at kind of the backdrop, and we go to slide 7, the aftermath of the election last November, and I'm pretty sure we showed this chart back in November, was eerily similar to 2021, when of course we were recovering from COVID. We had all the helicopter money, both from the Fed and from the fiscal side. That created a little bit of a Fed bubble, if you will, or like a rate bubble. The 10-year Treasury yield stayed way too low at 1% because the Fed eased for way too long. And it created a very low VIX, very narrow credit spreads, and a very low equity risk premium, which is in the left red circle there. And there's nothing wrong with that, but it tells you that the market is priced for perfection. And of course, we know that in 2022, inflation happened, the Fed slammed on the brakes, and we all know what happened next. So in November, we had kind of a similar backdrop, even though it was for totally different reasons. And again, it might have been justified, it might still be justified, but you're priced for perfection at that point, and that is really the risk. So where are we now? I think the market is bracing for a slowdown. It's priced for a slowdown. The PE is down a couple of points. Credit spreads are not ill behaving. So a slowdown is what the market is expecting. If we go to slide 8, you can see the GDP estimates from economists. The GDP growth numbers have been cut in half from about 2.5 to 1.3 for the first and second quarter. That's not recession, that's slowdown. And so now we have to figure out, are we going to have a recession or not, or just a slowdown? So one of the handy rules of trading or rebalancing, because we don't really like to trade too much, is that if the market prices in a recession that doesn't happen, that's a really good signal that the market has overcorrected. And if you look at the rising trend line in the top panel there, you can see that the market went from below the trend line in 2022 to above the trend line in late last year, and we're now at the trend line. So that tells me the market is finding its balance. But if we get a recession, chances are we'll go below the trend line and sort of the pendulum will swing all the way like it has done so many times in the past. So I would say there is not a juicy opportunity right now to rebalance into this weakness. But if it were to continue, and it may very well, because we're dealing with a lot of uncertainty here in the markets right now, then that will probably become a better opportunity. But for now, we wait for April 2nd,
Right.
and we'll see if it really was a sell the rumor, buy the news event, and that the markets are selling off into that date, and then we'll bounce. But we'll see.
We'll see, and it's a matter of hours away at this point. 2 charts back, when you were taking a look at the spikes for COVID, but then also that one for the yen carry trade. It was a massive spike, and I am curious what you think about, depending on which countries get hit worse, better, whatever, it will affect their currencies, presumably. Do you expect to see some sort of fairly large currency reaction? Even actually, the long-term capital management was happening around, as you said, a currency issue.
Yeah, and exactly. And we've already seen, of course, the moves. If we go to slide 19, and you're seeing this in Canada, of course, but slide 19 shows the US dollar index. And, it has weakened significantly, which is ironically exactly what it did in 2017 in Trump's first term. And you can see in the bottom panel, this is what the market is pricing in for expected rate cuts or rate hikes. And whenever the market is pricing in an easier Fed, the dollar goes down, and vice versa. And of course, what we're seeing now is that Germany is unleashing a fiscal impulse the way the U.S. did back during COVID, and sort of the brakes are off, if you will, and that's going to mean a better economy, better stock market. We're seeing that in European stocks already, but it also means a less dovish ECB, or maybe even a hawkish one. And we know what has happened to bund yields in Germany in recent weeks. And so it's always about rate differentials. So if the U.S. is now maybe closer to a significant slowdown or even a recession, while Germany and Europe is kind of is putting its foot on the gas, then that's probably all you need to know about currencies. But it is ironic that, again, part of the playbook, which was so obvious a few months ago, or seemed so obvious, was that the dollar goes up, and then everything else goes down because these countries get punished, and then
Right.
the U.S. reestablishes its supply chains. There's less buying from abroad, so more currency weakness. But the currencies are always really tricky to figure out. Famously, Alan Greenspan, when he was Fed chair, said that they put every resource you can imagine to trying to predict currency movements, and they couldn't do it.
Wow.
And so, because currencies, they're moved by what you're seeing on the chart. So interest rate differentials obviously are important, but also capital flows. And maybe capital that's been coming into the U.S. for years now, chasing the AI trade or just finding a growthier place to put that. Maybe that's now at risk, and of course in Canada you're feeling this because the Canadian dollar
Yeah.
obviously is very tied up in all of this, and so uh, maybe you're going to have a stronger loonie for a while if this persists.
Yeah. Maybe, maybe there'll be light on the other side or something. A couple of questions rolling in here, so let's put some of these to you.
And sorry, and you'll have a stronger Canadian dollar just at a time when no one wants to come travel to the U.S. anymore.
I know, just when we can't use it that way. How long, this is the question, how long might it take to see the true effects of tariffs? We're focused on April the 2nd, but I mean, they take time to actually implement and sometimes see.
Yeah, so and we were talking about this off the air earlier. I don't know that there is a one single smoking gun where it says, okay, this switch is flipped on the tariff side, and all of a sudden, everything goes to hell or everything recovers. I think there's little things that are happening, and then it's a question of which is the straw that breaks the camel's back. But just on the surface, there's been so much chaos, and I think part of that is deliberate. The very disruptive tactics of how to deal with this whole trade issue. But if you're a company in the States and you're looking at spending, on certain things, not so much on AI, but other things, capital spending, like what are you going to do when you don't even know what the rules of the road are going to be? And I think chances are you just sit there and do nothing, right? And so earnings season is around the corner in another week or so, and it'll be really interesting to see what the CEOs say. And obviously they're going to blame it on tariffs. They're always going to blame whatever goes wrong on the headline of the day, whether it's inflation or what have you. But it'll be interesting to see what the tea leaves are saying. But even just beyond that, if there seems to be fewer people visiting the U.S., somewhat understandable, but so you see it in some of the travel numbers. I sit on the board of a museum here in the Boston area. Well, I shouldn't say here because I'm in Santa Barbara right now, but in the Boston area. And museums and other NGOs, rely on government funding, not entirely, but some of their programs get funded by grants. And all of a sudden, those grants, we don't know if they're even going to happen. So, like at our museum, we're not heavily reliant on federal funding, but there are some projects that we do that are funded by those, and we've put those projects on hold. And so, like again, that's not enough to move the needle from expansion to recession. But if you add up all these little anecdotes, all of a sudden the scale could be tipped, and all of a sudden you're looking at a significantly less growing economy, or maybe even a contraction. And I think the glass half full is that if we do get a contraction, the one that we were expecting 2 years ago when the yield curve was inverted, if it's not associated with a debt bubble or a financial crisis, then this too shall pass. I mean, recessions do happen. They happen every 5 to 10 years. I mean, we've survived every other one. So on the surface, we still have a tendency to think when we think of recession, we think about the financial crisis or COVID. Those were really extreme storms, and that's not how most recessions happen.
But with that said, it's perhaps some of your charts, particularly that hot mess one that you pointed to, it's tough to step in. That's the other piece.
It's tough to step in, and I think one of the big challenges that we're all facing, and again, it's a question really without an answer, is what we're seeing today is obviously a rotation out of the crowded trades, right? So the Mag 7 is down 20+%. The S&P equal weighted is down 10. And we saw that last summer with the yen carry trade that you mentioned earlier. That was all Mag 7 because the yen carry trade meant investors would fund themselves in cheap yen and they would buy whatever was going up the most, which were the Mag 7. And then when that gets unwound, when the margin calls happen, obviously the crowded trade gets unwound. And so we're now in a position where that's happening again. That's why the Mag 7 is down more. But even if you look at the market today, right? Mag 7 is down 3%, S&P is down 1%, S&P equal weighted is flat. And so as an investor, how on earth do you position for that, right? Because the Mag 7 is a third of the market. So if you're going to buy an index fund or an ETF or some kind of index strategy in the S&P 500, you're going to be vulnerable to that unwinding of that trade. You can buy the Russell 2000, I guess, but that was down 20% as well. So how do you buy the equal weighted versus the cap weighted? So you go into the proxy trades, right? The proxy is non-US versus US. And so if you look at slide 15, I'll just give you the contrast there. This shows the Mag 7. That's a significant correction. And then in the next chart, I show the MSCI All Country World ex-US. That market has been sort of dead money for 5 years. 2021 is the last time we made a new high.
Until
but
now.
It's also not down, right? So, so this becomes a question of the beta, right? The market's going up or down versus the alpha. And I think the risk to the market here is not so much recession versus growth, but it's like, what does the beta and the alpha look like over the next few years? Is this going to be an environment where the Mag 7 is done? And again, I'm not willing to make that proclamation, but if it is, then it's quite possible that a global investor's beta, and of course in Canada you are almost by definition global investors, maybe your beta just kind of stays put and you make money for your investors on the alpha side. And I think that's potentially what we're looking at. And I'll show you one other chart, slide 14. And again, I'm not willing to say that this is the big one, the big rotation that is of a secular nature where the US starts underperforming non-US and the Mag 7 underperforms the rest of the market. But if you look at sort of the risk-return trade-off, right? So the annualized return is on the vertical, annualized volatility is on the horizontal. You've got the S&P there in the middle. You've got the MSCI ex-US there at the bottom, and you got the Mag 7 way in the upper right. Now, imagine if you have a meaningful rotation, not just a little correction in positioning, but a structural rotation like we saw in the early 2000s or in the second half of the 70s. And again, not a prediction at all. But if you were to get that, like how do the markets survive that? Like on the beta side, you can make lots of alpha, but it may be in a market that can't go up for a while because of that rotation. And that to me is one of the big existential questions. And it's the reason why we should be very diversified, right? I mean, right now there are things that are working. You have international stocks or non-US stocks, I should say. You have gold, of course, at 3,100. You have bonds are actually doing pretty well. And so I think we're in a position where we need to kind of cast a wide net in terms of what we want to own and how much beta we are pricing for versus relative returns under the surface.
Can I ask where that leaves the 60-40? As you mentioned, bonds are sort of doing actually what they're meant to do. So maybe it's all fine, but we've also talked about a bit of an adjustment to the traditional 60-40. What do you think now? Has that changed?
Yeah, so slide 20 is just my kind of back of the envelope approach. And so on the left side, you have, the traditional 60-40, and I'm speaking now from a US perspective. But for the last, 25, 30 years, all a US, an American investor had to do, or a US-based investor had to do, you buy 60% S&P and 40%, Bloomberg Ag, and you call it a day. Anything you did to kind of outsmart things probably just cost you money, or at least it didn't add to your return. So I think, whether the timing is now or in a few years in terms of the secular trend, I think a kind of maybe a more modern approach is is kind of a 50 20 30 or a 60 20 20 or a 60 30 10, something where you take some of the bonds, maybe some of the equities, and you bet on a lower beta, but you search for more alpha. So, cash is competitive. Again, gold, of course, is doing great. Private markets have done well. You have alternatives like managed futures. You got Bitcoin. And if we go to the next slide, you can see, especially on the alternative side, that alts have proven to be very successful replacements for bonds. And again, I think there's a role for bonds here. You're getting a positive real yield. They are actually kind of negatively correlated right now. Whether that continues or not, I don't know. But you look at equity long short, absolute return, global hedged equity, Bitcoin, gold, managed futures. They have very, very good Sharpe ratios over the last 5 years, and they're generally uncorrelated to the S&P. So that's what you want. You want to have positive returns without the correlation. And it used to be that bonds would have that, and maybe bonds will have that again. But you have other things you can put in there. And if we are going into a regime where the market goes up less strongly, or maybe not at all, we need to kind of paint this with a broader brush.
That's fantastic. There's a question coming in. Maybe I'll ask you. It kind of goes a little bit to the Bitcoin and maybe the crypto question as well. Are you concerned about de-dollarization?
Yeah, it's a good question. And I think that the questioner is reading the same posts on X that I am, because that is a theme there, that no matter how you slice it, if you want to bring the manufacturing jobs back to the US, which of course is what the Trump administration is trying to do, you may de-dollarize the world. And I think there's some validity to that argument. I don't think it would happen overnight, but maybe that's what gold is about. Other central banks have been buying gold quite aggressively. Gold's at 3,100-ish. It doesn't have the problems that Bitcoin has right now, which is that Bitcoin has this aspirational store value feature like gold, so it wants to be money, hard money, and I think that's true. But it's also highly correlated to the Nasdaq and the S&P 500, because with the democratization of Bitcoin via the ETFs and everything else and MicroStrategy, it's becoming more of a traditional asset, which means that asset allocators are allocating on it maybe for other reasons than its hard money status. And so Bitcoin has the risk that in a risk-off scenario, it's going to move in line with the stock market, which is kind of what it's doing right now, whereas gold is kind of untethered to that. Not to use a stable coin metaphor, but gold is just its own thing, right? It's nothing else but gold. It's not trying to be anything else. And so in that sense, gold is a pure play on hard money or de-dollarization. And Bitcoin, which I'm a believer in, is also that, but it has a Dr. Jekyll and Mr. Hyde thing where you never know which one is going to show up. And right now we see which one has.
Okay. I think we'll leave it there. It's an incredible walk through what we're doing in a much more measured way than sort of when you take a look at those charts on your own in the market. Jurrien Timmer, thank you so much for your time.
Thank you.